Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at FuelCell Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And right now, the story behind FuelCell Energy is it's arguably one of the most fascinating situations in the entire market today. We're essentially watching a legacy energy manufacturer try to pull off this massive high-stakes pivot.
Right, trying to become like a critical infrastructure provider for AI data centers, yeah.
Exactly. And the market is just reacting violently to it.
Yeah.
We're talking about a stock that is up over 250% year to date. I mean, it recently tagged a 52-week high of $37.88.
Wow, over 250%. That's a massive run.
It really is. But, just in the last 5 days, it suffered a brutal 28% pullback. It's sitting around $25.96 today. So the volatility is just completely off the charts.
Yeah, that kind of wild price action, up 250% and then immediately dumping nearly 30%. That's exactly what makes navigating these types of secular growth plays so incredibly difficult for you guys watching at home.
Oh, for sure. It's a roller coaster.
Right. And before we try to, untangle the fundamental story driving all this, if you're staring at a chart that chaotic and trying to make sense of the noise, you really need the right visualization tool.
You absolutely do, which is why having a structured way to read that volatility is essential. If you want some help reading trading charts more clearly, especially on highly volatile plays like this one, you can check out VIP Algos through the link below in the description.
Yeah, it's a super helpful tool.
It really is. VIP Algos is an educational TradingView indicator suite. Basically, it overlays visual buy and sell chart alerts, helps you spot trend directions, and maps out support and resistance zones. It's just incredibly useful for planning your take profit and stop loss areas before you get caught up in the emotion of a massive pullback.
Right, because emotion is the enemy when a stock drops 28% in a week.
Exactly. And you can use it across multiple markets, so stocks, forex, crypto, indices, you name it. But it is vital to remember that VIP Algos is purely an educational chart analysis tool.
Yeah, we have to stress that it is not financial advice.
Right. It absolutely does not place trades for you, and it cannot guarantee profits. Trading always involves risk, so you must manage your own risk and do your own research. Also, the link below is an affiliate link, meaning we may earn a commission if you use it at no extra cost to you.
Okay, so keeping that extreme price volatility in mind, let's step back for a second and look at the actual mechanics of what this company is trying to pull off. Because, let's be honest, every single tech company on Earth is slapping the letters AI onto their press releases right now just to get a stock bump.
Oh, absolutely. The hype train is very real.
Right. So why is FuelCell Energy's pivot actually structurally important to a long-term investor? Like, what is the physical problem they're actually solving here?
So to understand that, you really have to understand this massive macro trend playing out right now. The industry is calling it bring your own power. We are essentially in the middle of a physical infrastructure crisis.
A crisis, like the public grid just can't handle it.
Exactly. The traditional public power grid was simply never designed to handle the sheer, concentrated energy demands of modern AI data centers.
Yeah, to put that in perspective for you listening, training a massive language model isn't like running a traditional software application. You have thousands of specialized processors running at maximum capacity 24 hours a day. The power draw is astronomical.
Yeah, we're talking about single facilities that require gigawatts of power. Gigawatts. If you're a major tech company, often called a hyperscaler, and you want to build a new AI data center, you can't just plug it into the local grid.
Right, you'd blow the grid out.
You really would. And if you try to get utility approval, the utility company might put you on a wait list that lasts 3, 5, or even 7 years just to get the transmission lines built. The grid is at full capacity.
So FuelCell Energy is stepping directly into this bottleneck then?
Yes, exactly. Their technology allows these data centers to generate their own power directly on site, entirely bypassing the bottleneck of the public grid.
I like to think of it mechanically. The current power grid trying to supply an AI data center is like trying to fill an Olympic-sized swimming pool using a standard garden hose.
That's a great analogy.
The water pressure just isn't there, and the hose will eventually burst if you force it. What FuelCell is offering is basically to build a massive water tower right next to the pool.
Right. Problem solved.
But, I have to bring some skepticism here. If they have the perfect physical solution for a desperate trillion-dollar tech market, why did the stock just tank 28% in a week? There has to be a leak in the balance sheet somewhere.
Yeah.
Let's look at the underlying fundamentals from their fiscal Q2 2026 report.
Well, the skepticism is absolutely warranted because the current financials present a pretty stark contrast to that whole future narrative. If we look at the hard numbers, revenue actually dropped.
Wait, really?
Yeah, it was down 5% year over year, coming in at just $35.6 million for the quarter.
Hold on. If the tech giants are starving for on-site power, how is their revenue actually shrinking right now?
It comes down to the realities of heavy industrial manufacturing. That revenue drop was primarily driven by timing. Fewer module exchanges and lower output at one of their specific existing projects.
Ah, okay. So it's not just a copy-paste software solution.
Exactly. This isn't software where you can just duplicate code to meet demand. Building industrial power generation takes physical time and massive supply chains. However, there is a silver lining in the current operations.
What's that?
Their adjusted EBITDA loss, which essentially measures their operational cash burn, actually improved by 12%. It came in at negative $17.1 million.
Okay, so they're still losing a significant amount of money to operate, but they're becoming slightly more efficient at it, I guess.
Right.
But, losing $17 million a quarter while revenue shrinks, that doesn't really justify a stock surging 250% this year. The market is clearly completely ignoring the present and pricing in a massive future expectation. What exactly is the scale of that expectation?
The scale is staggering, honestly, and it entirely revolves around their forward trajectory. During the Q2 earnings call, management revealed that their proposal pipeline essentially went parabolic.
Parabolic how?
It expanded by 267% just from the first quarter, reaching an incredible 4 gigawatts of total proposed power generation. And the key detail here, roughly 90% of those new proposals are specifically targeted at data centers.
Wow, 90%. So the pivot is clearly showing up in the pipeline.
Very clearly. Because of this, Wall Street analysts are projecting an explosive growth curve. They expect revenue to scale from about $158.1 million in fiscal 2025 all the way to $1.1 billion by fiscal 2030.
Okay, projecting a revenue jump to over $1 billion is a great story, but executing a physical manufacturing scale-up of that magnitude, that requires a mountain of capital.
It really does.
And we've seen this before. A lot of speculative high-growth companies completely crush their own retail shareholders because they constantly have to issue new stock just to keep the factory lights on. How healthy is their actual balance sheet right now? Can they afford this?
Right now, their financial health is actually one of the strongest pillars of the bullish argument. They finished the second quarter sitting on $441 million in pure cash.
Okay, that's a decent cushion.
Yeah. Furthermore, outside of some specific project-level debt, the core company remains largely debt-free. But the really crucial development just happened with the Export-Import Bank of the United States.
The Exim Bank. Wait, how does a government agency fit into domestic AI data centers?
Well, it fits into their global revenue stream, which stabilizes their domestic ambitions. The Exim Bank just approved a $49 million financing package for FuelCell.
Okay.
And the first tranche of this deal is expected to deliver about $22 million in net proceeds, specifically to support delivering fuel cell platforms to South Korea. Ah, I see. And the mechanism that matters most to you, the listener, is that this is non-dilutive financing.
Exactly.
Yeah.
Non-dilutive.
Right. They're getting an injection of tens of millions of dollars without having to print millions of new shares and water down the value of the stock you might be holding. It's a massive lifeline.
Huge.
But let's look at the competitive landscape for a second. If this on-site power generation is such a gold mine, I'm struggling to see how a company doing barely $35 million in quarterly revenue protects its turf.
Yeah.
Why doesn't a giant competitor just swoop in and take these contracts?
Well, that is where their specific technological moat comes into play. FuelCell's flagship offering is their standardized 12.5 megawatt energy block.
Energy block.
Yeah, think of it like a massive industrial Lego brick of power. Instead of custom designing a unique power plant for every single data center, they can just deliver these standardized blocks and stack them to meet the required energy output. And there's a fascinating engineering advantage here, too. These fuel cells generate direct current, or DC power, natively on site. Traditional grid power is alternating current, or AC, which has to be converted back to DC because AI servers only run on direct current.
Right, the conversion loss.
Exactly. Every time you convert AC to DC, you lose energy in the form of heat. By generating DT natively right next to the server racks, FuelCell eliminates that conversion loss, making the whole facility dramatically more efficient.
Exactly. It solves multiple engineering headaches at once. But honestly, their biggest competitive advantage right now isn't just the tech, it is sheer availability.
What do you mean?
Well, their primary rival is a company called Bloom Energy, which manufactures highly regarded solid oxide fuel cells. But Bloom Energy is effectively completely sold out of their production capacity for the next couple of years.
Wow, totally sold out.
Yeah. Heavy manufacturing has hard physical limits. You cannot just magically build more factories overnight. Because Bloom is at maximum capacity, there is a massive, wide-open window for FuelCell to step in and capture market share simply because these hyperscalers are desperate. They cannot afford to wait 2 years for a competitor's product.
So if they have the cash, the tech, and a sold-out competitor,
Yeah.
we have to ask, when does this 4-gigawatt list of proposals actually turn into real money? What is the catalyst timeline driving the stock right now?
Everything hinges on the next 3 months. The absolute crucible for this company will be their Q3 2026 earnings report scheduled for September.
Okay, September.
The entire market is going to be laser-focused on one metric conversion. A proposal and a pipeline is basically just a handshake and a conversation, right? It means nothing until it becomes a contracted, firm backlog. Investors need proof that these hyperscalers are actually signing on the dotted line.
Right. And then what's next?
Then, in October, that second tranche of the Exik Bank financing is expected to close, adding more cash to the war chest.
And beyond the scheduled earnings, I know there's a lot of speculative rumor milling happening in the background, too.
Oh, there is intense market chatter right now regarding potential framework agreements. The rumors suggest FuelCell is on the verge of securing massive, multi-year deals with major tech companies. It's very similar to a massive 380-megawatt deal they recently structured with FIT Energy.
Makes sense.
Yeah, the logic is that because Bloom Energy is constrained, these tech giants will be forced to lock in guaranteed capacity with FuelCell now before they too run out of manufacturing space.
But let me push back on how the market digests that information. If every institutional investor already knows that the grid is failing, and everyone knows that Bloom is sold out, and everyone can see the 4-gigawatt pipeline on the public earnings call, isn't that exact narrative what drove the stock up 250% already? Hasn't all the good news already been priced in?
That is the ultimate dynamic of a high-growth stock right there. The market hasn't priced in absolute certainty. It has priced in a high probability of success.
Ah, probability versus certainty.
Exactly. The 250% run-up was the market saying, we believe these contracts are going to happen. If the September earnings report confirms that belief with actual signed deals, the stock could still re-rate significantly higher because the risk of failure is removed from the equation. The uncertainty vanishes.
And if they miss?
However, yeah, if September rolls around and that pipeline is still just a list of unsigned proposals, that 250% premium will evaporate violently because the probability of execution just plummeted.
Which brings us perfectly to the technical reality of the chart right now, because that exact tension between belief and fear is playing out in the daily price action.
It's the textbook definition of extreme volatility. We're looking at a high beta secular growth stock undergoing a massive fundamental re-rating. As we noted earlier, it is currently pulling back hard down 12.68% today alone, trading around 25.96.
Right.
But you have to zoom out and look at the structural trend. The multi-week picture is parabolically bullish. Over the last 13 weeks, the stock has returned a staggering positive 293.33%.
So structurally, this recent 28% slide over the last 5 days isn't necessarily a broken business. It looks more like a violent, healthy consolidation, like a profit-taking phase following an absolute monster breakout.
Exactly.
But what does the volume tell us? Because a stock drifting down on light volume is very different from a stock getting crushed on heavy volume.
The volume is running incredibly hot right now. It is currently trading at 2.09 times its 3-month average volume.
Double the average volume. That's huge.
It is. That tells us this isn't just retail investors casually taking profits. This is an intense, high-stakes battle between institutional buyers accumulating shares for the long term and sellers distributing shares to lock in that massive year-to-date gain. Furthermore, the stock carries a beta of 2.37.
Right. And for those unfamiliar with that metric, beta essentially measures how sensitive a stock is to the broader market. The market average is a beta of 1. So with a beta of nearly 2.4, this thing is hypersensitive. If the S&P 500 catches a slight cold and drops 1%, FuelCell is going to catch a severe flu and drop roughly 2.4%. It amplifies whatever mood the overall market is in.
Exactly. If macro sentiment shifts to risk off and people start selling equities, a stock like this will fall exponentially faster than a safe dividend stock.
So who is actually winning this tug of war on the chart? Let's decode the market sentiment.
The broader market perception is heavily bifurcated, but the underlying composite sentiment score sits at 65, which remains decidedly bullish. People are buying the AI secular trend.
Okay, but what about the professionals?
Well, when you look at the professional analysts covering the stock, the split is incredibly unusual. Out of 9 analysts, you have 3 rating it a strong buy, 4 sitting on the fence at a hold, and 2 rating it a strong sell. The street high price target is modeled at $32.
You almost never see professional analysts that violently divided. Usually they herd together.
Very true.
But this perfectly illustrates what we just talked about. It is a binary outcome. The strong buys believe the 4-gigawatt pipeline converts and prints $1 billion in revenue. The strong sells look at the current cash burn and believe the company will go bankrupt trying to build the factories to meet that demand.
Yeah.
There is no middle ground.
Right, it's all or nothing.
So what are the insiders doing? What do the people actually running the company think about their own survival?
That is perhaps the most compelling piece of the sentiment puzzle right now. The insiders have been aggressive net buyers over the last 90 days. We've tracked them adding 9,997 shares across 7 separate buy transactions compared to only 5 sell transactions.
Oh, wow. So they are actively buying.
Yes, and because of this, the management sentiment price ratio is currently sitting at a perfect 100.
When the executives are using their own personal wealth to buy shares on the open market after a 250% run-up, that is a massive signal of internal conviction. They're quite literally putting their money where their mouth is regarding this data center pivot. But, conviction doesn't change physics and it doesn't change math. We have to ground this management optimism with the harsh, ugly realities that could completely derail this entire thesis.
Let's look at the bear case.
The bear case is severe, and it starts and ends with their stark lack of profitability. If you look at the trailing 12-month data, their gross margin is negative 17.42%. But it gets much worse when you look at the bottom line.
How much worse?
Their net margin is a staggering negative 132.41%.
Whoa. Let me translate that into real-world impact so you can understand the sheer scale of the cash furnace we were looking at. A net margin of negative 132% means that for every single dollar of revenue this company brings in the door,
They are spending roughly $2.32
Sure.
just to keep the business running.
yes,
They are bleeding cash on every single operation.
that is brutal.
Precisely. And management has explicitly admitted this hurdle. They stated on the last call that they need to achieve consistent production and deployment of over 100 megawatts a year just to break even and hit a positive adjusted EBITDA. And getting your manufacturing capacity up to 100 megawatts a year isn't free. Building heavy industrial facilities requires massive capital expenditure.
And that is the ultimate execution risk. To meet this supposed AI demand, FuelCell is planning to drastically expand their primary manufacturing facility in Torrington, Connecticut. They want to push it to a 500-megawatt annual capacity.
Sounds expensive.
Very. That expansion is projected to cost between $200 million and $275 million.
Wow. Think about that math. We just established earlier they have $441 million in cash total. This single factory expansion is going to consume over half of their entire cash reserve.
It leaves absolutely zero room for error. If they spend $250 million expanding the Torrington facility, and then September rolls around and they fail to secure those firm contracts from the hyperscalers,
They will have drained their war chest for a demand that never materialized.
Exactly. The downside risk here isn't just that the stock dips back to $10. The risk is a catastrophic structural failure of the entire business model.
It's the ultimate high-wire act. I mean, if they scale flawlessly, they corner a billion-dollar AI infrastructure market. If they stumble on the factory build-out, they could burn through $500 million in cash in a matter of years. So looking at the full mosaic weighing the massive structural AI energy bottleneck against a negative 130% net margin and terrifying execution risks, where does this leave us? What is the final verdict?
Synthesizing all these factors, the final bullish score comes in at a 7 out of 10. The fundamental stance here is that this represents a high-risk, highly asymmetric reward profile.
And how should you contextualize that timeline if you're looking at it?
This setup is primarily geared as a swing trade leading into the Q3 earnings, so we are operating on a 3 to 6 month view. The entire upside thesis depends completely on management, proving they can convert that 4-gigawatt proposal pipeline into actual signed revenue contracts.
And the downside?
The primary downside risk is their immense cash burn and the danger of failing to execute the Connecticut factory expansion efficiently. If you're the type of investor who can stomach massive 30% intraday volatility for the chance of catching a structural market re-rating, this is a fascinating setup.
But if you're not?
But if your portfolio is built around safe, profitable, dividend-paying companies, you should stay incredibly far away from this stock. And please remember, as always, our analysis is strictly for educational purposes and is not financial advice.
Exactly. And navigating a chart with this much embedded risk requires clarity. If you want a cleaner, more systematic way to visualize these violent price swings, check out VIP Algos through the link below in the description.
Highly recommend it for these volatile plays.
Yeah, VIP Algos is a TradingView indicator suite that provides visual buy and sell alerts, dynamic trend direction tools, map support and resistance zones, and clear areas for take profit and stop loss planning. It really helps cut through the noise of a 28% pullback. But again, it is purely an educational chart analysis tool. It is not financial advice, it does not place trades on your behalf, and it cannot guarantee results. Trading inherently involves risk, so always do your own research and strictly manage your downside risk. That link is an affiliate link, meaning we may earn a commission at no extra cost to you.
So when we zoom out from the charts and the margins, what is the core takeaway for the listener to consider here?
I want to leave you with a much broader, almost philosophical concept to ponder about the future of tech. We started this discussion by outlining how the traditional public utility grid is failing to support AI. If that grid is already bottlenecked today, what happens in 5 years?
It's a great question.
Right. Are we entering an era where companies like Amazon, Microsoft, and Google effectively have to become their own utility companies? If big tech has to permanently secure, build, and manage their own private gigawatt-scale power generation just to keep their servers online, that fundamentally changes the global energy landscape in ways we are only just beginning to comprehend. The tech sector and the energy sector are colliding.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.